Welcome to the Real Money Show, and thank you for listening. The number 18778 Silver, the website guildhallwealth.com. I'm Jeremy Wiseman. I'm joined with Jerry Correia, and we've got a lot to cover today, Jerry. We want to talk about building a portfolio in gold and silver, also talk about an exit strategy. Let's talk about what the experts have to say in general. What does it mean to listen to the experts? And, of course, why own gold? Before we jump into that, and I know you've got some articles as well, I want to start with some comments on YouTube. It's great. We've been starting to get a lot of comments, wonderful comments. I love what we're seeing. But I saw three that came across that I thought we should touch upon just to give some feedback on. So the first one, Jerry, was someone was listening and they said, it's always a buying opportunity. It's always a buying opportunity with you guys. So let's get into that. I think that comes with the building a portfolio in gold and silver and talking about an exit strategy. So it's not always about buying opportunities with us. It's a question of when that exit strategy is going to be a part of the overall scheme. So let's talk about exit strategies, shall we?
Yeah, good idea.
All right, let's get started. First, we want to build that portfolio to understand what the exit strategy means. For you, Jerry, what does it mean to build a gold and silver portfolio? So if someone comes to you for the first time and says, "Where do I start?" Where would you guide them?
Always with a little bit of both. Obviously, you want to have some gold and some silver in the account. And for myself, traders, investors, they tend to just look at the silver to gold ratio. And right now, silver is very undervalued versus gold, so having more silver than gold is the way I position it. It's just to keep it very simple. And what about yourself?
Oh, you jumped ahead on me there in terms of dividing the portfolio too. I see it in sort of three ways. Mm-hmm. The first is building up a cash component of your precious metal portfolio, meaning you might have some cash on hand for a rainy day. You should have some physical gold and silver on hand for a rainy day. Sure. For me, the goal for me was always, let's get 10, 15 ounces of gold into a safety deposit box and hope I never have to touch it. Right? It's obviously a lot more expensive today to get to the 10, 15 ounces. But to me, that was always a great place to start. And then for cash component at home, people always have some cash on hand for a rainy day. Maybe have some tubes of maples on hand for a rainy day. And then once you've completed that kind of cash purpose of the portfolio, now you might start looking to diversifying the overall portfolio. So maybe you start to look at the investment side of things. And that's where we see a lot of people moving pensions over, moving RSPs over. It's really their investment side of the portfolio. So with that, the typical advising is to have 10-15% allocated to precious metals. Actually, there was a great article I used to send people all the time. It was from 2017, but it was from Bloomberg, and they had an editorial, and the author decided to put the hedge to the task. Right? What does it mean to put 10-15% gold in the portfolio? And he was pretty negative on gold, but in the end, he said, you know what? It actually is a really good hedge. It improved the portfolio overall, but by I think about 10%. So, and that was in 2017. So that was good. And then I think beyond that, now you start to go into maybe a 10-15% allocation for your net worth. In other words, using gold and or silver as a hedge against your real estate, right? The idea that, what if they call the loan? Right, you want to have some assets, not just cash on hand to handle those sorts of things. I know people have mortgage insurance and that sort of thing, but at some point you could start to think of it in terms of what's my net worth. I should have 10-15% of gold and silver as part of my net worth. Now, in terms of an exit strategy, there's a few different things that you can look at. What are some of the things that you look at for your clients?
Well, yeah, it goes back to the silver to gold ratio, and I start with the silver to gold ratio because, yes, it's a good buy to maybe start and get a little bit more aggressive with silver and own more silver than gold. And then when the ratio tightens to 30-1, 15-1, 12-1, who knows, that's when the strategy would be to employ a sell on some silver to roll it into then gold, which now would be on sale. or silver to real estate index, silver that can buy you another hard asset for your overall portfolio, looking to other investments. But it's always a foundation of gold and silver as the foundation of a portfolio. As we remind viewers to check out the Exter's pyramid for wealth, power money is at the bottom of that pyramid, and power money happens to be your physical gold and silver, which is what you build the upside down pyramid, leading up to more risky assets. The bottom foundational piece is your gold and silver. So as long as you have your gold and silver, your insurance for the portfolio, go off and take more risk.
The number 18778-SILVER, the website guildhallwealth.com. We're talking about how to build a precious metals portfolio in order to understand how to exit the precious metal portfolio down the road. Now, for us, Jerry, I think, and a lot of clients know this, we'll say this to them, that we know at some point when gold and silver become a good value, they're no longer undervalued, that there will probably be a mass exodus from the market. And at that point, you know, we were talking about this just before we went on air, that the idea is that hopefully by that point, people will also understand that they really should have 10-15% allocated in precious metals. So when you were talking earlier about, okay, well, if you know you have a certain amount of silver, certain amount of gold, the ratio narrows, right? The amount of silver it takes to buy an ounce of gold becomes less. Right now it's probably in the 70 ratio. If that comes down closer to the historic norm of 15-1, 16-1, then that would be a good time to convert to gold. Or that might be a time where you say, okay, I'm going to sell all my silver at that point because I have my gold. As the 15% in my portfolio. So all of the silver I'm happy to sell and go into the other risky assets, or maybe they don't feel so risky anymore. Maybe if the ratio between gold and the Dow has come down from 11, 12-1 down to 3-1, down to 1-1, then it becomes pretty clear it's time to sell a lot of gold and move into the real estate market, right?
That's
Equally right now, it takes a lot of ounces of gold to buy a house. At some point, you could bring that, at some point gold will take off and it all of a sudden becomes a lot less gold, right? The purchasing power of gold increases. And so you can sell some of your gold to go and buy real estate, that's perhaps, right? So that's the idea there. Now, not everyone is holding 10-15% though. I mean, where did that come from?
It was a study. Well, I think it came from a study. There was a good study that was done in 2009 by the Ibbotson Associates, foremost leaders in asset allocation models. And they concluded that, yes, just like this article, the Bloomberg article that you noted back in 2017, it was Marco Mann who wrote that article. He also, his results were the same for the Ibbotson results that prove that without an allocation to physical gold or silver, your portfolio is simply not diversified whatsoever. But so they took into things like, what do the debt situation look like globally? What does the inflation rate look like globally? What are the risks happening? Geopolitics, what's going on in the world? Back then, in 2009, they concluded, yes, you should have up to 15%. That was then, though. So today, with much more debt, much more geopolitical issues, uncertainties, distrust, mistrust, the allocation has been a lot higher. And our clients want more than 15%. I'm a lot higher than 15%. And I don't blame them.
Yeah, and there's someone we follow in the industry, Egon von Greyerz, out of Matterhorn Asset Management in Switzerland.
Yes. Great
writer, great leader for the market.
For the industry,
I really enjoy his writings, and also he's got someone else working with him now who's doing incredible writing as well. His name escapes me at the moment, but he's a sound money enthusiast. He has been very open in certain interviews about how the wealthy are diversifying their money. And I think with Matterhorn, I think the minimum is $400,000. So it is really the top 1% are investing with him or acquiring gold and silver with him and storing. And he talks about the fact openly that most of them have way past 15%. And when it comes to an exit strategy, it's exiting into what?
Right. Where do we go from there? What does the world look like? And unless the ratios then make sense for us to, sell my silver and maybe get into an undervalued stock market, yes, that would make more sense. But to sell it today, where do we put our where do we put our money right now? The IMF just came out with a report that the Canadian real estate market is overvalued by 39-40%. CMHC says we're, highly, there's a lot of risks in real estate. So where else do we go from here? We have to look at what's undervalued. And right now, gold and silver are last to that party. So this is a perfect buying opportunity.
So it is a buying opportunity in the market. Sorry,
right
still
back to it,
still
yes.
a great buying opportunity. But again, we've given you some exit strategies. There's certainly other factors that you can look at for the exit strategy. But we do provide those exit strategies with our customers and teach them how to do this and teach them for what to look for in the market so that they. One of the things that we often are teaching and prescribing is this idea of looking at other aspects of the market so that you're not caught up on price. Mm-hmm. It's understanding the value. It's understanding the ratios, the ratio of the portfolio, the ratio gold to silver, the ratio of gold to the Dow, gold to real estate, silver to real estate, silver to the Dow. Mm-hmm. All of these things to get a sense of value, but none of these things are directly affected by the specific price itself. So that ultimately you can derive that value and then look at some of the technical sides of the market to decide, are they all falling in line at the same time? So with that, we're going to go take a quick break, and then we're going to look at some of these other comments and also look at the experts in the market. What does this all mean? At Guildhall, we only deal in physical precious metals, gold, silver, platinum, as well as natural fancy colored diamonds, which we'll talk a little bit about later in the show. But it always has to be physical. And before we get into this idea of listening to the experts, Jerry, there was another great comment on the YouTube channel talking about that someone, I guess there was a discussion going on, and someone was saying the difference isn't between non-allocated versus allocated in terms of, the SLV and what's happening with that. But it's between the PSLV, which is Sprott's ETF, which is physical, versus the SLV or GLD, which is paper, right? Mm-hmm. And I think, anyone who knows about Guildhall knows that we actually take that whole setup one step further, because for us it is about allocated. Right. It's not about backing your quote-unquote investment with physical product, but actually allocating that physical product to the client themselves, mm-hmm. specifically in the registered accounts where the client gets their own inventory report, where they know that it's in the sub-account, so it's basically a warehouse receipt to say these are the specific products that you hold.
Mm-hmm. And that's probably the most sought-after thing when someone calls us. Can I take it home? Can I go visit it? Is it there for me? Yes, it's in an RSP, but at the end of the day, if I need to get it, if I need to do a withdrawal, can I get physical, or is it converted to the cash and then I get the cash? No, you're getting physical. This is the most important thing. If you're going to be acquiring insurance, you better have the policy, as we say. You need the physical because central banks, we know around the world, minus Canada, need physical gold in their reserves at all times so that they have independence from runaway currencies, hyperinflating currencies, and liquidity. Those are the two things that they need, and that's a general rule. So if you don't have the physical and if it's not in your name, you should question it and talk to someone here at Guildhall about it.
Yeah, and the idea within the registered account as well is that, okay, most people, let's be honest, they don't want to pay the withholding tax in order to remove the product. But the point that we're consistently getting across is that if you do want to pay that withholding tax, then that's it. You pay the withholding tax, there's a small cost to ship it to you, mm-hmm. but there's no convertibility cost. You're getting the bars that are on your inventory report. Mm-hmm. And so I think that is something that gives a sense of, allows you to go to sleep at night.
Yeah,
right?
It's awesome. It's awesome to be given that option of, if you want the physical, you can take it home, or you can sell it and take the proceeds in cash.
Yeah, and one of the most frustrating things about COVID and the protocols has been that we haven't been able to invite clients to go to the vault to personally audit their holdings because it was such a unique experience, and we invite it. We want people to be able to do it. And unfortunately, during COVID, there's that risk that you have to protect the staff at the vault. And they've limited the amount of people coming in and out of the vault, so they've had to limit that as well. It's not something we want to limit, but unfortunately it is what's happening right now. Speaking of COVID, Jerry, I think after a year I think a lot of people are reflecting because it's been over a year at this point, just over a year, and people are looking in the rear view mirror at what they've experienced over the last year. And I think they're starting to really question what's going on. This idea that the politicians just simply deferred to the experts, right? And shut everything down, the economy down, and didn't think about any of the other consequences. Meanwhile, the experts were taking their advice from World Health Organization, which, if you're looking at that, you realize, well, they're taking their cues from the Chinese Communist Party. And so how much are we willing to trust those experts in that regard? And I think the takeaway is that the experts we've trusted to keep us safe have shown themselves at the end of the day to be either completely inept, because nothing's changed. We're still on the verge here in Ontario of another lockdown, or they're threatening that, or they're criminally negligent. And we can't decide which it is, right? We don't know when they're actually going to testify to their decision making. And what I've personally noticed as well is that the media, in terms of this, have done nothing but propagate fear because it's great for ratings.
That's right.
That's my opinion.
No, you're
what
absolutely right.
are your thoughts on it?
Everywhere you turn, you can go to any network, and it's the same narrative, sometimes exactly the same. They're using the same verbiage, the same sentences they're using.
Did you see that clip where they took took like 30
networks.
sub-networks, and they all had the exact same narrative speech?
Yeah.
That was crazy.
I mean, you can't deny seeing that video. They're saying the same things in order to, stoke fear, because with fear, you become paralyzed. You don't want to make any moves, and that's where they can release whatever mandate, whatever policy they want to impose onto people. So we have to kind of, at this time, do reflect, look back. Has anything changed? No, let's start making a move.
Yeah, and what have we learned, right? And it just seems like the politicians, again, in just deferring everything to the experts, where's the backbone in all of it? You just feel like, where's the backbone? And you just feel it now bubbling over, where people are completely fed up with what they're seeing. And we're about to get to where this has anything to do with gold and silver. And the question is what do you have to show for it after a whole year of just blindly listening to the experts? And that is, you've got gargantuan increased spending. You've got increased suicides. You've got increase in substance abuse, increase in violence, increase in inflation. And it's all not over yet.
And divisiveness,
people are still getting money from the government. The government's about to pull the punch bowl away and stop putting money into the bond market and stop paying out for all of this. So they're about to say, you're on your own, right? And what is that going to look like? It starts to make me think, you were mentioning in the last segment about the 70s, I think we're starting to see the quagmire of the 70s, rear its ugly head again, where you've got stagflation, where all of a sudden the economy doesn't have GDP. Oh, and by the way, they're taxing us, right? And raising, they're putting through the carbon tax, and they've already started to raise tax. And Biden's looking to crazy raise taxes to pay for infrastructure, which who knows how rich people are going to get off that. But what a waste of money it's going to be through all of it, right? Because it's always just a waste of money at the end of the day. Some things get done, but it's like, at what price?
Huge cost.
So I think the idea of listening to the experts becomes one of, well, where's the transparency with the experts? Show me, talk to me like a real person. Don't just propagate fear in our way. At Guildhall, when we're talking, being experts, having been in the market for a decade and a half, that the idea is, what have we learned from it? What have we read? We're here to be honest with people. We're here to teach you why gold is important to have in your portfolio, and for people to do their own research. There's enough out there that people can, and the best part is there's a conversation. That's right. There's actually a conversation in the gold and silver market. We're talking about some of the people who are part of that conversation in our YouTube group right now. And the idea is that you can actually have a free-flowing exchange of ideas and get to the bottom and figure out what's right for you.
It's so important to be able to, glean from, in the midst of all of the noise, to really think for yourself, and you can even draw enough information to make your own conclusion and come to a conclusion where, it comes to a point where I have to kind of mute all of the noise, trust your gut, trust where we are right now, and see the trend of where this is headed. What is the next step? Where do you think this is going? And once you play this game of chess and really understand that you're in the game and you're one of the pawns, you need to make your own decisions. You need to make the best move for not only just for yourself, you're in this for your family, for most people, generational wealth. And this is just one part of preparedness. Prepare with other things. But in terms of, safeguarding your wealth, 100% gold and silver and natural fancy colored diamonds all the way.
And, when we're talking about listening to the experts, let's talk about what other experts politicians listen to, right, and defer to, and that is the economic experts. I mean, oh my gosh, sometimes I have to pinch myself and I knock myself over just remembering that Janet Yellen is now the Treasury Secretary. And I heard her speak the other day, and I was just, oh my, I think her tone of speaking is practiced. I think she's learned that on purpose. If I just talk in the most monotone, stuttering of ways, then I could probably baffle anybody, right? Where BS baffles brains.
Yeah.
I really feel like that because listen, she never had a job. She's a pure academic. She couldn't see the housing crisis when she was the head of the San Francisco Fed, right? Which was ground zero, almost, for the subprime mortgage crisis. So, let's not give her too much credit. It's very easy for a chairman of the Federal Reserve to sit there and say, we're not going to do anything. We're just going to keep rates where they are, But by the way, we're happy to print money, and the Fed has printed so much money. They're close to $8 trillion already. When do you start to lose faith in the Fed? Anyway, I digress on Janet Yellen. The fact is most of the times the economic experts that the government is paying attention to and deferring to as with regards to the whole economy are alumni of some of the largest global banks. And the question I have is, how's that working out?
Not working out one bit. That's for sure.
What do we have to show for it? You've got out of control debt, which everyone can see now with COVID. You've got inflation. Don't tell me there's no inflation. Don't tell me that your gas prices haven't gone up, that your food prices haven't gone up, that that your real estate prices haven't gone up.
Yeah.
And investors, this is where it really starts to get me. I kind of witness and notice that investors, there's this now a trend that all investors believe that gains have to be immediate. It's like,
Very
no,
true.
it all has to be immediate, that it's all the fear of missing out. That is the driver of investments now. It's, I can't miss out on this. I can't miss out on that. And since all of the assets are all completely overvalued, except for gold and silver, no one pays any attention to it. They've become immune to it.
Yeah.
Right? They don't pay attention to it anymore. The fact that all of these stocks are completely overvalued, the real estate's overvalued. They don't seem bothered by it, as if it can just last forever. I always think of the Roadrunner running off. They just haven't looked down yet, but it's going to happen.
Yeah. Yep. And, the fear of missing out is a huge trend, especially in the crypto space. I know I got caught up when it last, was it 2017, 18? I understand it very well. It's a very strong emotion. And as far as investing goes, emotions aside, trust the gut, understand what people are doing. And I saw an article this week about the Russian National Wealth Fund thinking about, the economists. They're totally diversifying away from U.S. dollars, and they're turning to gold. the National Wealth Fund falls under the direction of the Russian Finance Ministry. So the Russian government is mandating, and now the National Wealth Fund is actually, their main purpose is to support the nation's pension system. So they are mandating, let's do something responsible. Let's, in light of all of the inflation coming, let's own some physical gold in our fund. And I turn to Canada. Reminds me of when I tried to own some gold with my financial planner. He said, why do you want to do such a stupid thing? There's no yield. There's risk in holding it, all of this jazz. And as soon as you tell me not to do something, I'm going to do it. And that's what pushed me to gold. But besides that, it turned me to what's going on in the CPP. We'll talk about this later on, the Canadian Pension Plan. But the C.D. Howe Institute, the number one think tank in Canada, in 2000 and I believe 6 or 7, had a paper about what's going on. Why can't Canada own some physical gold in their pensions? And that was way back when. Forecasting issues, forecasting inflation, forecasting today, what we see in Canada today, if we only had some gold in the pensions.
The number 18778-SILVER, the website guildhallwealth.com. You're listening to The Real Money Show on Global News Radio, 640 Toronto. We'll be right back. Welcome back to The Real Money Show. The number 18778-SILVER, the website guildhallwealth.com. We're talking about physical precious metals, how they can protect a portfolio. We've been talking about the fact that it's been tough to look at the experts and what they've been prescribing to everyone, and we're looking back and saying, how well did that work? Listening to the experts in this case, you look at the media and they seem only interested in fear at this point. I have a tough time personally watching it at this point. In the economic media, or finance media, I should say, it's complete opposite. It's all about calm. Mm-hmm. It's all about, we're just going to give you an air of calm. And anyone with a few brain cells is looking at that saying, what are you hiding? Mm-hmm. I mean, anyone can look at the overvaluations, and sure, as long as the Fed keeps printing money, it can keep going into that market. So you could have a hyperinflationary stock market. Who knows? Now, what you were saying, Jerry, is that the pension fund in Russia, I believe, or the government body that handles the pension plan is looking to hold gold mm-hmm. as a hedge to all of this type of stuff?
Yeah, so it's just a contrast between the experts here versus the experts there. We're all people. We all have to experience the same things. We all have to eat and shop and enjoy life. But some experts are recommending gold. So I just thought it'd be very important, and I think we'll talk about that more next week.
Speaking of, we've mentioned a couple times the sort of the 70s, and I think it's becoming more important now. And I think about how gold and silver performed in the 70s, because oftentimes you just think about the one run-up in 1980, mm-hmm. right? But what about what gold did as soon as it was lifted from the gold standard, and it basically ran from $35 an ounce to $200 an ounce mm-hmm. by 1976, and then it dropped down to $100, which is still like 2.5 times gain right. in the market. And then within another 4 years, it moved up to $850. So if you were to look at the overall decade and how gold would have protected you during times of stagflation and inflation and, capping, right, controls on goods and prices, price fixes and all of that stuff, at the end of the day, gold did exactly what it needed to do. That's right. Not only that, but by the time we entered the 80s, and gold had gone to $850, it had been one of the largest wealth transfers in history, mm-hmm. And I think that is something that can happen again. It's just a question of looking at what everyone is doing and thinking, is this right? Is this madness? Let's think a little bit outside the box and a little outside the mainstream, even though I believe gold and silver are going more mainstream these days.
Absolutely. They certainly are. We're looking at people and even sectors of communities that haven't discussed gold at length are now turning towards physical gold and silver for a reason, and that reason has to do with the things that we can see every day, which is inflation and loss of purchasing power. And thanks to the show, the Real Money Show, I think we're doing a really good job of giving the Canadians some information that can go a long way.
Now, one thing we haven't discussed yet on the show, we are recording today on Wednesday. The show will be posted on Saturday. But one thing we haven't talked about is the fact that the price has come down.
Yeah.
Hey, look, silver bulls don't panic, right?
Exactly.
When the going gets tough, the tough gets stacking. We're seeing a lot of buyers into the market today. The phone's ringing, a lot of buzzing at the door. But ultimately, look, even with higher premiums, it's still down a couple dollars. It's still a chance to buy a little bit cheaper. Finally, in Canadian dollars, able to get silver sub $30 with the premiums. So I think that's been a great buying opportunity. Are you finding the same thing, Jerry?
I think this month, the last couple of weeks have been an amazing opportunity, and there is a lot of things happening behind the scenes, especially with the Federal Reserve, that are causing this type of run up and setup for precious metals. One of them happened to be this yield curve control. So today, yes, we're recording on March 31st. It's Wednesday, and happy Easter and Passover to those who are celebrating. But this yield curve control is a topic that has come up, and today is the end of a technique that the Federal Reserve launched at the beginning of COVID last year, and it's called the supplementary leverage ratio, the SLR. And what it is, it basically has to do with liquidity, obviously, with the banks, and how they view their ability to print money. So they took away. So there's a thing called this ratio, the supplementary leverage ratio. And what it is, it's a ratio of assets versus leverage, and they've removed some of those assets.
Is this one of those things, Jerry, where they basically allow you to have less collateral?
Yeah, it basically gave them the ability to remove U.S. Treasuries and excess reserves at the Fed from leverage calculations. So they are permitting them to print more, to acquire, to print more debt, and this deadline comes to an end today. So what happens is this yield curve control to keep the 10-year Treasury yield down can't happen until they deal with this expiration, today's date. So there's a lot of writers that are waiting for this to happen, because once they do this, once they extend this, which they will likely do, they can implement yield curve controls. Okay. Drop that 10-year Treasury yield.
Okay.
And silver and gold are off to the races. So this is your buying opportunity, because as of today, this writer who wrote this back on March 15th from Seeking Alpha, his name is Astrolib, he's the writer, and he is explaining this in depth of what this means. And imagine, if this is a lot of jargon, I know, but it's very similar to TDS and GDS ratios for mortgages. When the banks want to lend you something, they look at what you're making, your income, versus your debts and your credit card debts and line of credits. Imagine the bank removed your credit, your debts, one or two.
They'd lend you more.
They'll lend you more. This is exactly what they've done, little tricks and twists, but they can't. This has to end, and the yield curve control will come to play, and silver and gold are going to be off to the races.
The number 18778-SILVER, the website guildhallwealth.com. Stay with us. We're going to talk about more about the dip in the market right now and the opportunity that provides for you. Again, the number 18778-SILVER. You're listening to The Real Money Show on Global News Radio, 640 Toronto. Welcome back to The Real Money Show, the number 18778-SILVER, and the website guildhallwealth.com. Remember, if you're looking to acquire physical precious metals, please visit us at guildhallpreciousmetals.com. That's our e-store. Or you can acquire directly from us. You just give us a call at 18778-SILVER. Or you can also look to have some physical precious metals in your registered accounts. Maybe you have a pension that you've been holding that isn't performing very well. Maybe you want to put it into your RESP for one of your kids. Maybe you've got a TFSA where we see a lot at Guildhall people who've sold some real estate or sold some assets, and they're not quite ready to jump into the stock market, aren't happy having less than 1% gains at the bank, and so they decide, hey, let's go put the funds into the TFSA and hold some physical gold and silver. Now, with that said, we are seeing a dip in the price, Jerry. We're seeing silver around just over $24 an ounce. So we did break below that $25 price range. Gold just dipped below the $1,700 price range, and it has that kind of feeling pre-COVID when silver had that slam down, and right after that slam down, it was really off to the races. Except that silver went down to 11, not 24. What are your thoughts on this pullback in the market?
It has all to do with the yield curve control that they want to implement, and this extension of the SLR, the supplementary liquidity ratio, that the Fed. So as soon as the Fed extends this SLR, this writer wrote 2 weeks ago, and begins yield curve control, its balance sheet is obviously going to burst higher once again. And gold and silver are most likely to fly higher, as they tend to do when the Fed balance sheet spurs higher. That would be bad for the sizable short position of the swaps category on the futures markets. As we see, JP Morgan is one of these banks, along with Goldman Sachs, Morgan Stanley, and others, all subject to SLR restrictions on holding treasuries when they coming April 1st. In any case, the pace that we're seeing since COVID and even since January has been faster of them covering these short positions. So these little dips happen so they can cover, knowing that they will implement this new yield curve controls, and they won't be burned. These banks will not be burned as hard.
So, Jerry, what you're saying is that what the Fed is doing here, one of these tools that they're trying to use to get more leverage into the system and be able to print more money because they don't have to worry about as much collateral as it were, or different debts, that it's going to help them push the yield curve down, get the interest rates down, which does what? Gives the impression that everything's fine?
Well, they've been increasing. It's all algorithm plays. So as soon as the 10-year yield starts to rise, that drops gold, because the banks, the algorithms say, well, we got to chase yield now. Gold offers quote unquote no yield. So it gives them the opportunity to cover their shorts.
But the problem with that is that at some point you end up like Greece did in 2012, right? Where interest rates going up is not a reflection of a good thing. It's a reflection of risk. And how can anyone not look at the amount of debt in the system and say, oh, well, higher interest rates mean there's value there? Yes, there's a certain point, right? There's a certain point where higher interest rates are a good thing. They're a good sign. 6%, 7%. Once you start going much, much higher and into double digits, it's a sign of risk.
That's right.
It's actually a sign of there's a reason you're going to get this much return, right? And I think that giving a signal of 1% or 2% to the market, or, well, just not negative, is somehow a good sign. That seems ridiculous.
100% it is. That's a ridiculous ploy. So this article just basically summarizes, because of the short positions that these bullion banks, JP Morgan, Morgan Stanley, need to cover these short positions and reduce their risks. But even more so, a bigger risk, again, that silver is the Achilles heel. The silver and the gold, they're disappearing. The physical is being removed out of the market. So this charade, this big act is going to come to a complete halt.
Do you think that this pullback in the market, even just to the $24 level on silver, is going to be enough to get some of these short positions lowered? Do you think we'll look back next week and we'll see that they've covered some of these short positions?
Oh, they did. I mean, if you look back at the COT reports up to March 8th, they did cover quite a bit. They've been doing that for over 2 months now. 2 months now, with a lot of gusto. So they've been doing it as much as possible. But now that this deadline is here, they're going to have to. That's pretty much going to come to an end for covering these shorts.
Yeah, anytime I see a pullback in the market, I always think that desperate times call for desperate measures. I always feel that pullbacks in the gold and silver market are a sign of desperation on the part of the financial system, whether it's the Fed or the bullion banks themselves. It's a money maker, but to me, it's more of a desperate thing. And I think it's just a great opportunity for anyone who hasn't entered the market or is looking to cost average. It's a great time to get more into the market. And if you have your allocation and you're happy with your allocation, then you don't have to feel like it's a complete missed opportunity, or you just you sit with it and you have a little bit of patience. I have found a little bit that, again, this idea that people don't want to wait for anything, right? Slow and steady wins the race. And that's certainly the way with gold and silver. They're up 11% a year on average for the last 20 years. And natural fancy color diamonds, same thing. Slow and steady wins the race. We'll talk about more about that over the next few weeks. But slow and steady has won the race with hard assets. It's a great way to go.
Yeah. Calm heads will prevail. And again, as long as we understand and put in place our why, our purpose, and why we're doing this. This is the foundation, and this is going to be here for the long haul. It's not about the return on my money, it's the return of my money. And you want to be able to know that this wealth is going to be here for generations to come.
You've been listening to The Real Money Show. We've been talking about how to hold physical precious metals in the portfolio. The going gets tough, the tough get stacking.
Yep.
And silver bulls don't panic.
Never.
And we can't wait to speak to you again next week on The Real Money Show. The number 18778-SILVER, the website guildhallwealth.com. It's The Real Money Show on Global News Radio, 640 Toronto.